How fast can the US economy grow before inflation becomes a problem? That question is not just academic. It shapes every interest rate decision the Federal Reserve makes, and new research from Fed economists is taking a fresh look at the answer. The concept at the center of this work is called potential GDP. Think of it as the economy's speed limit, the maximum sustainable pace of growth without stoking price pressures. Push past it for long enough, and inflation tends to follow. Stay well below it, and you have slack, room to grow without worry. To estimate that speed limit, economists start with the labor force. How many people are working or actively looking for work? How quickly is that pool expanding? And crucially, how many new jobs does the economy need to create each month just to keep the unemployment rate steady? That last figure has a name: break-even employment. It is the monthly job creation number that absorbs new entrants into the labor market without moving unemployment up or down. Run above it, and unemployment falls. Run below it, and the labor market loosens. The Fed researchers are revisiting these estimates because several key inputs have shifted in recent years. Immigration flows have changed, the population is aging, and the share of people actively seeking work, the labor force participation rate, has moved in ways that are still playing out after the pandemic. Each of those shifts affects how many jobs need to be created each month just to hold the line. Why does this matter beyond the academic exercise? Because the economy's speed limit feeds directly into how the Fed thinks about neutral interest rates, the rate that neither stimulates nor restrains growth. If potential growth is lower than officials assume, even a seemingly moderate expansion could push against capacity and reignite inflation. If potential growth is higher, the Fed has more breathing room to keep rates relatively low without triggering price pressures. This research does not signal any immediate shift in Fed policy, but it is part of the underlying framework that officials rely on when setting borrowing costs over the medium and long term. These estimates quietly shape every rate decision, even when they are not explicitly mentioned in the headlines. The practical takeaway here is to watch how the Fed describes potential growth and neutral rates in upcoming statements and meeting minutes. When officials revise those estimates, even subtly, it can signal a shift in how much room they think the economy has to run. That in turn affects the entire rate outlook, from short-term policy decisions to longer-term bond yields and borrowing costs across the economy. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.